talk to me about our interest rates as we sit here still at 2.75. What are we going back to right now?
Yeah, we're going back to October of 2008. We're still that high. They're still a little bit restrictive on that side, but I just don't know. We might see one more cut. Maybe we'll see two. But with the amount of money that governments are spending, that's going to increase inflation. You just simply can't get rates down to where we saw in the past unless something drastic
Yeah.
happens. So they're going to stay higher for longer. Um, but like I said, I honestly think the fixed rates have bottomed.
Hmm.
And I don't think they're going to get any cheaper. If we're staying the same course, if something significant happens and they need to get the economy going again, we go into a hard recession, then it's possible. But I don't see too much more downside to this market over at least the next 6 to 12 months.
Yeah. And for those that are still hoping for that big price turnaround, when we saw prices going up like we did in the past, these are where the interest rates were. They're at 1% and below. And we're just not going to get back to that anytime soon, it feels like. Again, obviously 2020 leading to our 2022, that tremendous hike that we had, we're sitting down at a quarter of a point, right? In terms of the Bank of Canada. Same there in, '09 to '10, sitting around that 1% as we ran up and dropped down right at 2016, where all of a sudden we were seeing almost a month over month increase on the Toronto board of 100,000. I remember at the beginning of 2017, we all looked at each other like, okay, this is getting out of hand. Something's going to break here. And sure enough, by April 2017, it did. Now, talk to me about the 5-year bonds, because now this is where we start to see more of a direct correlation in regards to our fixed rates.
Yeah, we're starting to see, the bond yields start to tick up. Why they're ticking up is because there's not enough buyers for the debt. So they have to make it worth their while, which means, the interest that they make on the bond has to be a little bit higher. Now, the government of Canada, or the Bank of Canada took all the government debt on their balance sheet to drive interest rates down to zero, but they're still running that off the balance sheet right now. So they're not really in a position to start buying back the debt, the government debt, to help, because by the central bank buying the bonds, it actually drives interest rates lower because there's a lot of demand for the bond. So they can get away with paying a smaller interest rate. But right now, there's just not a huge appetite for it at these levels. So that's why I think that for the next little while, we're fixed rates are going to probably bounce around this level, just because the Bank of Canada can't really absorb all the extra bonds that the government might need to be putting out there. I think ultimately what might happen is the government might have to force pension funds in Canada to start absorbing the debt, and making it mandatory that they have to hold that on their books.
Interesting. Interesting.
But that takes time to get through. So
Yeah.
that's something we haven't heard yet. But then when it happens, it could take 6 to 12 months for it to get to that point.
Yeah. All right. Well, again, I just want to point out to people when we're talking about pricing, look at where the fixed rates and the bond market, because again, this is the chart for the bond market that impacts the fixed rates, where they were when we saw those big run ups in prices, 2015 to, of course, there the start of 2017, and then our 2020 up to 2022 before they really started climbing, hovering around that 1% mark. And it's
And if
funny,
you
look,
see
go
from
ahead, Matt.
2015 to 2017, that was the market buying the bonds.
Yeah.
That was, the economies were running fantastically. And that was the market buying it. And then all of a sudden, after 2017, they didn't want to touch it anymore. And then COVID happened, and they had to just buy. Like, that's when the central bank stepped in, and I believe they added like 1.2 trillion to the balance sheet,
Mm.
and that's what ultimately drove the rates down again.